This is a Silicon Valley real estate market update for the week ending November the 7th, presented Saturday morning, November the 8th. These are the chapters we're going to be going over. The order's a little bit different. Let's just get right into it. So this is the summary slide showing inventory in the purple line. So inventory is essentially normal. It's about 4% more than normal. So you basically have normal level of inventory. You can see we've had normal level of inventory now for about a quarter, halfway through third quarter and halfway through fourth quarter has been basically normal level of inventory. Before that, we had a surplus of inventory compared to normal. And I look at the past 10-year median. Swapping over and looking at offers, we're now down at about 82% of the offers that we would expect based on the past 10 years. And you can see that we were basically been at that level for the last 2 years. Before that, in 2023, we were only at about 70% of the level you'd expect. We did have a surplus after the pandemic, but we are missing about 20% of the marketplace. You can see before the pandemic, you had sort of normal levels of transactions. And then the key indicator, the days unsold inventory, the supply-demand balance, is a little bit slower at about 8% slower than normal at 108%. But again, that would all be within the realm of normal. So the speed of the marketplace and the selection of the marketplace is essentially normal. What is missing is we only have 80% of the pie. So we're missing 20% of the pie. Here now is looking at each one inventory. You can see this, the current data is the purple line, and it stops in the middle of the chart, which is the current week. I go back 13 weeks of full quarter, and then I go forward 13 weeks of full quarter on the trend data. The trend data is obviously the past 10 years, not including 2025. So it's 2015 through 2024. You can see at this time of the year, inventory normally goes down for another 2 months, 8 weeks, and then it starts climbing up again as we go past the into the new year. You can see inventory has been just slightly above the normal line. Here you can see the actual numbers, 103%, so 3% more than normal. I think I was saying 4% on the previous slide. 3% is obviously the correct number because I was just estimating the 4 off the graph. The raw counts is 2381. The purple is the current week data, basically. And then the colored code over here is the blue always favors the buyer, surplus inventory favors the buyer. The typical would be your median for the past 10 year, and then a shortage of inventory would favor the seller. So red is always a red hot seller's marketplace, blue is always an ice cold buyer's marketplace, purple is always the current data points. Moving on to offers accepted, you can see that we're doing a little bit better right now this current week in the center of the graph. We're above the blue line, but we're below the gray line. A quarter ago, you can see we were right on the blue line. So we've gone from a very sluggish marketplace into a marketplace that's halfway between a sluggish marketplace and a normal marketplace. And that's as far as the offers accepted. And an offer accepted is no longer an offer accepted if it falls out of escrow. Transactions, on the other hand, are closed transactions, not a leading indicator, but it is what the industry runs on. So that's why I've included it. And you can see it's a little bit more pessimistic. It's pretty close to the blue line. You can see right now we're selling about 82% of what we normally do, right at 2,000 transactions. Normally, year would be at 2,400. Days unsold inventory is the supply-demand balance, the number of sellers trying to sell versus the number of buyers. You can have a lot of sellers as long as you have a lot of buyers and the market remains in balance, or you can have a shortage of sellers like we currently do, and also a matching shortage of buyers, and the market also remains in balance. Real estate is extremely local, and Silicon Valley is not like any other marketplace in the country. Anyway, you can see a quarter ago, we were taking 52 days to sell out our inventory, which was 28% slower than normal. Now we're only taking 42 days, so we're taking 10 days less to sell out our inventory, and that's closer to normal and only 8% slower than normal. So again, you can see that you're a little bit favoring the buyer, which would be a slower marketplace from the typical gray line. Marketing time is an easier metric to understand. It's simply how long is it taking 3 out of 4 sellers to sell. 3 out of your 4 sellers are going to sell faster than this 31 days over here on the purple line. And 1 out of 4 is going to take longer than 31 days. And that's only 5% longer than normal. Normal is 30 days. This is 31 days. No seller, no buyer, no agent's going to see the 1-day difference. And, statistics is to give you a ballpark of what's going on, a large amount of data statistically presented so you have some understanding of what's happening. It's basically going to feel like a normal marketplace. Then price cuts. These are average price cuts. We will talk about the 90 percentile price cuts later on in the presentation that I think is a better metric. And the reason for that, in these numbers, as you can see, 1.5%, 1.5% is very small. That's because most of the sellers do their homework, and basically only 20% of the marketplace, even in a slow marketplace, is participating in price reductions, because the 80% or and sometimes more, and rarely less than 80% of the sellers price their home correctly. And so the homes come on the market, they sell, and they sell without having to ever do a price reduction. So you're adding in a whole bunch of zeros. So anyway, typical is 1.2% price reduction. Right now you're at 1.5. That's a 28% larger price reduction than normal. It sounds like a small number, but again, when you look at the sellers that are actually doing a price reduction, they're taking a 15% price reduction, which is pretty significant when you're talking about a $2 million home. Overbidding is not a leading indicator in any stretch of the imagination, because you need the sale price, which means it's a lagging indicator. It's on here because it's a high degree of interest data point. A quarter ago, we were at 3.3%, and you're normally at 6.1. So we were 3% less overbidding than normal on magnitude. Now we're actually, in just 13 weeks, we're now at 5.5 when you're normally at 5.1. So we're actually more competitive than normal. And that's why, if you pay attention right here in the middle of the graph, the purple line is actually above, favoring the hot sellers marketplace of the gray line. So we're actually getting more aggressive overbidding now, where 13 weeks ago we were getting less overbidding. So that's why it's important, in my opinion, to look at the data frequently, is it does change. Here now is a summary of the micromarket areas. The big takeaway on this is the green highlights, which is the left-hand side of this chart, is simply showing you how the market compares to normal. And you can look at this overall, and yes, there are some areas and some metrics that show up in either red, like Foster Cities. 0% of the sellers did a price reduction. You can't get better than that. I guess you could get price increases, but 0% of the sellers doing a price reduction is essentially the best you can get. And most of the areas, though, are favoring blue. So it's basically a little bit slower marketplace, favoring the buyers a little bit more than Silicon Valley normally favors the buyer. But then come look at the yellow section. The yellow section is sort of your leading indicators. And frankly, the DUI is the most important one, in my opinion. And look how red that is. Price adjustments, and which are these two, and even days on market is completely normal. They're lagging behind because the market can change today, and then it takes time for that change to show up in marketing time and price adjustments. So even though they're all leading indicators, in my opinion, the days of unsold inventory is the most leading indicator. So what it basically saying to me is, you've had a marketplace that was cool, and now you're heating up a little bit. And then you have the two overbids in the orange, and that's because they're lagging indicators. So the market was actually a little bit hotter when those transactions were negotiated 5 weeks ago, and then another 5 weeks, because I do a 5-week sampling point. So, 5 to 10 weeks ago, the market was hotter than it is today, is sort of what I would probably take away from that. Then you have long-term appreciation in the price range. And on price range, instead of just following the middle number, which is the median, I follow the lowest 10 percentile in a given area, as well as the highest 90 percentile on the far right, which gives you a sandwich. You have a price range for each micromarket area. Here's some notes for those that are going on their own. Here's the first graph of geographical map of the data, and this is active inventory. So basically, you can see the map is mostly white in color. There's one section of red and one section of blue. So again, that says that you have normal inventory. You can actually see the numbers over here. Santa Clara County is at 90%. San Mateo is at 101%, and Alameda County is at 104%. Here's offers accepted, same concept. Now you can see a large swath of fairly deep blue, and also Alameda County is a light blue. So there's basically a lack of offers. And in Santa Clara County, you can see it's 77%, followed by Alameda County at 82%. But then you flip into San Mateo County, which makes those three counties make up Silicon Valley, you're at 97%. So you have one county performing normally and two counties that are missing 25% or 18% of the marketplace, depending on which of the two counties you're talking about. And even within Santa Clara County, which is missing the most of the inventory, you can see there's some areas where it's white in color and you have the normal amount of offers accepted. This is looking at days unsold inventory. So now you're comparing still to the 10-year median. You have to compare the number of offers and the active inventory to the 10-year median, because just raw count of numbers depends on the size of your geographical area, where if you're comparing it to the 10-year median, you've taken into consideration the size by doing the ratio. So here, what you're seeing is the Silicon Valley overall is 8% slower than normal. Santa Clara County is 6% slower, San Mateo County is 7%, and Alameda County is 11%. So they're all slower than normal. But would anybody notice the difference between 6, 7, and 11%? I would say no. But you can see you might have one area like Redwood City, it's at 67% of normal. And then you have an area like San Mateo County Coast at 152% of normal. Yes, you're going to notice the difference between that. Or even San Carlos to Redwood City, 115% to 68%. You're going to notice that difference in the speed of the marketplace. And we'll get into raw count next. So now we've done away with the percentages. So let's look at Redwood City. Redwood City is 25 days. San Carlos is 29 days. Well, 4 days isn't a whole lot. So here you had a huge shift in percentage, but the raw count that is what you feel when you're out there in the marketplace isn't very different. But you are going to feel the difference between, say, Foster City in 21 days and then going over the San Mateo County coast at 91 days. That would be night and day difference. The coast being very slow and Foster City, Redwood Shores being very quick. You can see there are a few areas over in Alameda County that are fairly slow in the marketplace. I believe from what I saw in the data, and it's more from memory because you have to go back past weeks, when the pandemic first happened, these outlying areas that were more affordable had a lot of appreciation, a lot of interest. And I think now that people are coming back to work more frequently and doing more regular commute hours, the commute is wearing on them and they're coming back. And basically back in, I think it was the 90s, we had commuter loans that had a higher foreclosure rate because they went out to the Central Valley and then they got tired of the commute and they came back into the Silicon Valley area marketplace. I think the same thing happened, but not going out as far geographically. So this is the raw count. So 37 days to sell out your home marketplace, that's a fast marketplace. So even though it's slower than normal, this is what the buyer's going to feel. So a buyer's going to feel a fairly fast-paced marketplace. You got 27 days in a good part of Silicon Valley. The highest number in all of Silicon Valley is going to be, well, you have these two outliers, the two deep blue areas. But if you ignore those two, then you have 91 days and 72 days and then 58 days. You have some areas, a handful of areas that are slow or quite a bit slower. But look at all these days that are under 30 days. There's a lot of areas that are moving quickly. And then there's areas like Fremont at 19 days. So Fremont's in a real aggressive marketplace at the current moment. Here's the marketing time. So marketing time now is a little bit more normal. It's all white. So marketing time compared to the 10-year median is normal. What is the marketing time in Santa Clara County? It's basically 23 days. The county overall is 30, but there's the center part of Silicon Valley is 23 days roughly, because you have areas like Saratoga, Los Gatos, and Morgan Hill, South County, that are slowing down Santa Clara County overall. And those two micro market areas, for whatever reason, are slower than normal. So they're slower than the rest of the Santa Clara County. You get into San Mateo County and everything's fairly normal looking, but you ignore the coast and then the real expensive areas. And again, a good part of the San Mateo County is of just about 3 weeks, 22 days. And if you look at Alameda County, is even though the days unsold inventory was up there at like 100 plus days, I believe, your marketing time is only 31, 34 days. How can I explain that difference? One of the big differences is with days unsold inventory, you're looking at active inventory. That includes all active inventory, including the sellers that never sell. Where marketing time, I'm looking at the time for the offer to come in. So if the offer never comes in, that number never comes into my database. So your marketing time is only for successful sellers. And that's a key difference to keep in mind. If you're just talking about the average seller, the average listing, days on market is going to be higher than these numbers. But if you're looking at days to time to get the offer in the door, the numbers are more aggressively low because you're ignoring the unsuccessful sellers. Here's the ask price reduction compared to normal. So now you can see that you got a lot of blue here. So you're taking more price reductions than normal. So this is actually the current list price to original list price. So it's a percentage. And that's why these numbers of 96% is a negative number. And I actually think I'm going to change it over to price reductions, but I'll probably wait to do that at the end of the year. The concept is, do you do a ratio of a seller comes on the market at 100% and then they take a 5% reduction, they're now at 95%. Do I count that as a 5% price reduction, or do I say they're getting 95% of their original ask price? I started off with a graph doing the 95% of original ask price, but then I call it price reduction. So it's confusing. And I think price reductions makes more sense. So I'll probably change that over to price reductions at the new year. Here's the magnitude of those price adjustments. So how big are those price reductions? You can see that on average, those numbers are pretty small. 0.5%. I mean, the biggest number overall I'm seeing real quick might be 3.3% in Atherton, 3.5 in Saratoga, 2.6 in South County. So, you know, a 3% price reduction is not a huge number, but for an average to be there, it's huge because a vast majority of the sellers do no price adjustment at all. Here's the frequency of price adjustments compared to normal. So here, less frequent price adjustments, since price adjustments are in the downward direction, is a positive thing. So Milpitas at only 83% is pink. Foster City with no sellers doing a price reduction is bright red. Pacifica at 148 is a shade of blue. But overall, you can see there's very little color on the map. Sellers are doing about the normal in price reductions. What is that frequency? Well, you can see that in Santa Clara County, it's 21%. It's 21% in San Mateo County and 19% in Alameda County. So right at that threshold where 80% of the sellers are doing no price adjustments. But then you go down to the San Mateo County coast and 45% of the sellers are doing, so that's essentially every other seller is doing a price reduction. Or you go to South County, 37%, that's better than 1 out of 3 sellers are doing a price adjustment. So it varies quite a bit. In Milpitas, it's only 1 out of 10 sellers are doing a price adjustment. This is overbidding. And again, this is a lagging indicator because you need the sale price. So you need escrows to close. But you can see that overbidding is 4% more than normal. And this is just raw numbers. So this is 4% more overbidding than normal, 1% less overbidding than normal in Milpitas. Because I thought doing a percent on a percent was confusing. So I did an actual raw number there. Overbidding and average, how much is the overbidding? In Cupertino, it's 10%. You drop right next door into Saratoga, and it's 1.3%. In Morgan Hill, they're actually reducing the sale price. And that may be what most people would expect on a high ticket item is for the buyers to negotiate down. But as you can see, most of the average overbid is above the seller's ask price. In San Mateo County coast is -4%. So that's a huge price reduction. All the other micro market areas are positive. And in Alameda, the one negative area is Pleasanton with a 2% reduction, and all the other micro market areas are getting overbid, and that's on average. This is the frequency of overbidding. So how common is overbidding? You can see it's not common at all in the blue areas. And this is compared to their 10-year normal. So they're only getting 70% of the normal marketing overbid that they normally get, 20% on the coast, 50% in Foster City. So even though Foster City isn't doing price adjustments, they're doing less overbidding. They're only getting half the overbid. But then you go up in Saratoga, Los Gatos, that was, if I remember correctly, was doing price reduction. They're actually getting 14% more overbidding right now on a frequency basis than a normal. So one of the things that does happen is sellers do price adjustments, and then the buyers come in and overbid with that price adjustment. Here's the frequency. So what are the raw counts? So in Saratoga, it's at 50%. The lowest area is at South County, we're right at 30%. The lowest everywhere is the San Mateo County coast with only 1 in 9 sellers getting a price reduction. So it's sort of a pretty amazing area where you go from 1 in 10 sellers getting a price overbid in the San Mateo County coast to, say, Berkeley, where 8 out of 10 sellers are getting overbid. So again, that gives you an idea of how important it is to pay attention to the marketplace that you're working in or trying to buy or sell in, because there's a huge difference between 1 in 10 and 8 out of 10 sellers getting an overbid. Here's where the appreciation has been happening. Again, I think it's got to do with the pandemic. The San Mateo County that was very close to the job center and people were paying huge premiums when they could work less in the office, even though they're going back to the office, when they could work less, the premium dropped, the affordability was out here, and that's where the buyers went when they could remote work. So you can see the appreciation. You have basically in Santa Clara County, you have had 97% appreciation, Alameda County only 71%, and San Mateo at 74%. So it's clearly Santa Clara County outperformed the Alameda and San Mateo County in appreciation since the last 9 months of 2015. Now you're looking at the price range. So this isn't market conditions, but blue is affordable, red is high expensive areas, and that's what people would expect. And again, in the middle number is the median. On the left-hand side is the cheapest 10%. On the right-hand side is the most expensive 90% in each area. So it's sandwiched for you. And this is the same chart that we already went over at the beginning. It's just there for a recap. Here is how we participate. We have been talking about Silicon Valley real estate market. We'll talk more about it in greater detail next. And we'll finish up the last 7 minutes or so on the Greater Bay Area, which is 13 counties and 5 regions. The blue YouTube link here is the archive channel. You can also type in the shorter green root URL to join the presentation Saturday morning at 9 o'clock sharp. I don't start early and I try to start on time. You add the green root URL in 2025, or you can type in the longer Zoom link if you don't want to do secondary links. The PowerPoint slide did get up. It was about 5 minutes before the hour. Green root URL plus H for handout 2025, 1108 for today's month and year, or you can type in the longer Google Drive. This is the current week's Google Drive. It changes every week, and sometimes I have time to update the slides, other times I don't. I'm Richard Calhoun, real estate broker here in Silicon Valley with Creekside Realty, working with buyers or sellers in single agency transactions. And I've been doing statistics, started on my own account in 1997. Here's what we're going to go over next for those that are doing it on their own. This is the key distributions. The first one is marketing time. So here what you do is you start off at the 50 percentile. And the reason I start at the median is the data, as you can see together, is very close together and really doesn't change very much. And that's because those are the people that come on the marketplace and sell as soon as the seller's willing to look at offers, whether that be 7 days, 10 days, or 14 days. It's roughly the same number, no matter whether the market's hot or slow. The marketplace that I look at is the 75th percentile, where you can see the data lines get spread out by quite a bit more. If I was starting all over again and I knew what I know now, I'd probably pick this 85 percentile mark. I picked 75% because a lot of statisticians look at quadrants. But you can see the purple line and the dotted line, which was a year ago, which is what we're going to start off on, are almost on top of one another, very close together. The purple line is slightly cooler. The dotted line up here is the worst we ever had. So this is your cool marketplace. Down at the bottom is your red hot marketplace. Last year and this year were basically the same. I wouldn't say there's any significant difference. Stepping through, you can see that we're expecting the market to slow down like it did last year. So that's the direction I'd expect. There's the slowest on December 27th. Then the market picks up. Look how quickly by January 24th. Now, I pointed this out. Look how steep the right-hand side was over here. That's the market still going down. Now the market's leveled off, and so did the steepness, and now you're cooling off. So that's one of, not as only the line falling, the right-hand side is getting steeper as the market heats up. And then as soon as it starts cooling, it levels off. Now you're up here and you're bouncing around, and the solid lines are the most recent. Now you can see the improvement that we've had. So the market did get sluggish. Now you're slowing down again for the end of the year. But we were up here earlier this year, the purple's like middle of August. We had a slowdown, and that was sort of the slowest time. And then we heated up, and then we're slowing down for the end of the year. So going forward, I'd expect these marketing times to continue to increase until the end of the year. And then I expect them to go quite a bit shorter next year. Same concept now, looking at the sellers that are doing the largest price reduction. And why do I call it the largest? Because I'm looking at only the sellers that are taking the 97.5 percentile. So the largest sellers down to only the 82.5 percentile. So I'm looking at 15% of the marketplace only, the very top end of the marketplace, but I chop off the top 2.5% because it tends to be data garbage. The concept is the same. We're going to start off on the dotted line, which was last year, but you can see on this particular metric, the purple line is quite a bit cooler than the dotted line. So sellers are taking significantly more price reductions this year than they did last year. And this would be magnitude, because the top 2.5% last year were taking a 13% price reduction. This year, they're taking a 15% price reduction. The 90th percentile seller this year is taking about a 93.5% price reduction, which would be a 6.5% price reduction. And last year, they were only taking a 5% price reduction. So roughly 2% more price reductions for the sellers that are doing price reductions. And you can see that's even true out here at the 82%. And you can see it's a little bit more frequent, because last year you were at 0 sellers at 82.5%. And this year, you're still taking a 3% price reduction. So this line's going to be down on something like 70% of the sellers are doing a price reduction, or 30% of sellers are doing a price reduction. Stepping through, you can see the dotted lines of the oldest lines. You can see it's falling towards the blue line, which is the coolest. That is the coolest in the middle of December, a little earlier than you might think. Then you're raising up rapidly, where there's the peak, the least price reductions, middle of February. Then you're cooling down already again. So it cools down fairly rapidly. There again, that was right around middle of July. You could see sellers were doing a lot of price reductions, and that's middle of September, which was the absolute lowest. So we again had that slowdown in the August timeframe. And then you can see we heated up, and now we're cooling off for the end of the year. So there was definitely a slowdown this year. We do have that sometimes. Some years it's more significant than others. There's typically a slowdown around August, September every year, and then we pick up just for a short period of time, and then you hit Halloween, and when you hit and it starts slowing down more significantly, and you hit Thanksgiving, and it really cools off in Silicon Valley, more so in Santa Clara County even than the other two counties. Now we're looking at the lagging indicator overbidding, same concept. You can see the purple line is cooler than the dotted line of a year ago, but not by much. It's more like the first slide distribution. Stepping through, you can see the market really isn't moving yet. And now it's starting to cool down. And this is going to be into New Year's, in fact, January 24th, because of the 5-year lag, 5-week lag time. There's the peak of the marketplace right about there, March 22nd, April 5th is also right up there. Now you're already cooling down. So you can expect the market to continue to cool from wherever we are now and then heat up as we get to the new year. Here's sort of the bottom of the middle of August. But remember, the overbidding was 5 weeks earlier than that. So again, that's sort of the July timeframe. Now you can see that you're just sort of floating around, and there's the current week. So what would I expect? I would expect to go from here down for the end of the year and then turn around and go up after we hit the end of January. Here's some notes for those that are doing it on their own. Here now what we're doing is we're comparing Silicon Valley to the 10-year median. So the gray line is the median. The red line is based on the past 10 years, either the 90 percentile or the 10 percentile. For inventory, it's the 10 percentile. So this is the least number of inventory you'd expect. The blue is the most inventory, the 90 percentile. So you can see that earlier in the second quarter, we had a surplus of inventory. We're at the 90 percentile. Right now, we're right on top of the gray line and have sort of been following the gray line fairly closely. There was a little diversion here, but pretty close to the gray line since the middle of third quarter. So that's why you basically have normal level of inventory. Here's on a percentage basis, so you can see the surplus that we had earlier in the year, and you can see basically since the middle of third quarter, we've been basically having normal level of inventory. This peak down here is simply Labor Day. Labor Day is not date certain like July 4th or upcoming this week. Veterans Day, which are date certain, this isn't date certain. So when you're looking on the 10-year medians, it gets spread out between 2 weeks, where a given year it's concentrated in 1 week. So you have a dip down. Here's offers accepted. You can see we've been following the blue line, and we've been following the blue line essentially, in my opinion, since middle of 2022, right? Was you cool down from the superheated marketplace in 2022. Yes, there was times like in 2023 when we were actually below the blue line, and a little times when we were above. But for the most part, given the amount of data that fluctuates, I would say we've been basically following the blue line, the least amount of offers that you'd expect. And right now that's about 80%. You can see here on a percentage basis, it was a little bit greater back here. I'd probably call it 70%. I would probably call 2024 20%. And I'd actually probably be a little optimistic if I call 2025 at only a 15% missing overall. Right now we're closer to 20, but overall for the year, because we've had these two high peak mountains, I'd call it about 15% of the market missing. Here's days unsold inventory. You can see we were slower earlier this year. You can see we've been right on the normal line, more or less. But even now, we are all cooler than normal. So this more was a perturbation while you were right there, and we would have to call cooler than normal, now between cooler than normal and normal. Here's on a percentage basis, so you can see how slow we were earlier this year. You were record percentage basis just, a quarter and a half ago, and now you're almost normal. That's how quickly this market can change. You can see at the first of the year, you were hotter than normal, rapidly became a record cooler than normal, then rapidly became back to normal. So the market does change, sometimes more than people even perceive. Here's marketing time. You can see marketing time was quite a bit longer, and now it's right back on normal. And it was coming racing down, and it did this abrupt turn, and it probably will go up because the seasonal impact is so severe at this time of the year. Here's compared to normal. So you're right now at about 5% or 4% slower marketing time than normal, but darn close to normal marketing time for 3 out of 4 sellers. Here's the percent price reduction. So here's where you get the 14%. So sellers are asking 86% of what they originally were asking. So that's a 14% price reduction, and that's closer to 15%. So the sellers that are doing the price reduction, the largest 10%, the 90% seller, is taking a 15% price reduction, which is pretty significant. Here's the price of the 90 percentile. So they were taking bigger price reductions earlier than normal. Now you're still taking larger than normal, but only by about 20% larger. This is the average of the price reduction. So because so many sellers take no price adjustments, that 15% or almost 15% price adjustment for the 90 percentile becomes a 1.5% reduction when you add in all those zeros. And that's why I prefer the 90. I do the average because it's a more common statistical tool. Here's the average on a percentage basis. So you can see you're getting pretty darn close to normal. Here's the frequency. So 20% of the sellers, about 20.5% of the sellers are doing a price reduction right now in Silicon Valley. Normal would be about 19% on the gray line. In a hot marketplace, it would be down at 12%. In a cool marketplace, you'd be up here around 25%. This is on a percentage basis. So you can see you're about 8% more sellers taking a price reduction than typical. Here's overbidding, and this is median overbidding. So this is the midpoint. I did the average that you saw earlier, which I think was 5.8% or something like that overbid. This is the median. So half the buyers are bidding their offer more than 2% over the seller's ask price. Half the buyers would be less than 2%. And the less than 2% would include those that go in less than the seller's ask price. Here's on a regular typical number, and this is raw count. So typical, if we were at typical, you'd be 0. And I think typical was 5% or maybe 5.1. And we were actually at 5.9. So you're that 0.8% above typical, which is why you're on the high side of the normal typical line. This is the frequency of overbidding. So how many sellers are getting overbids? A little bit over 60% for Silicon Valley, but that's less than normal. Normal's up here about 65%. We're probably about 61%. So about 4% of the less sellers are getting overbid currently compared to the 10-year median. Here's on a percentage basis. So you can see you're about 92% maybe of the sellers, the number of sellers that typically get overbid or overbid. So you're missing about 8%. That's close enough to normal. In fact, most of my metrics are about 12.5% on each side of 100 as I consider normal. Here's the pricing model. The more accurate one is to say that we had 12.1% price appreciation for 7.5 years, and then we've been basically flat. You can see the improvement in price, but notice that this last week we turned around and we're now have a mountain point. And another reason I like to do weekly statistics is I believe it takes 3 data points to do a trend. You don't know right now if that mountain peak is going to be a mountain peak or is it just going to be a fluctuation. So next week we could go up or we could continue down. If we're going up, then you have had a long trend up. My gut feeling is that's probably the beginning of a downward trend. But until you have a couple more data points, you don't know that. And if you look at monthly data, you've lost a whole quarter of the year, where if you do it weekly data, you're only missing 3 weeks. Here's some more notes for those that are following on their own. Here now we're looking at each component in Silicon Valley, comparing the 3 counties. So San Mateo County down here in the orange, less inventory, but it's also a much smaller county. So you need to adjust these. Santa Clara County is next at just over 800 listings, and then Alameda County has 1,200. And you can see before the pandemic, Santa Clara and Alameda County were much closer together, except in 2017 when Santa Clara County sort of had 2 years of appreciation in one, and the other counties really did not participate in that. But anyway, you can see inventory is going down in all 3 regions for the end of the year. Offers accepted. You can see Alameda County is only accepting slightly more offers than Santa Clara. So Santa Clara is going to have a faster turnover rate than Alameda. And you can't tell that from San Mateo because it's so different. So let's look at the data. So your turnover rate, San Mateo County and Santa Clara are identical at 38 days to sell out their existing inventory. And Alameda County is at 48 days. Marketing time, very close together for all three counties. At San Mateo and Santa Clara County sitting at 30 days for 3 out of 4 sellers to sell. Alameda County is only at 32, almost no difference. Price reductions, the magnitude of those price reductions, this is average. So San Mateo County is doing the largest price reductions at 1.8% price reductions. Then Santa Clara County at 1.6%, and Alameda County is doing the least price reductions at 1.2%. Here's the frequency of those price reductions. You can see they're all very close together. You have Alameda County at 19%, San Mateo County just under 21%, and Santa Clara just over 21% of the sellers reducing their price. And this is the sellers reducing their ask price prior to the buyer submitting their offer. Here's the overbidding. This again is a lagging indicator. Every time I try to remember to say that. Santa Clara County is basically somewhere around 3.75% over the seller's ask price on average. The San Mateo County is next at about 5.25%, and Alameda County has the most overbidding at 7.5% over the seller's ask price at the time this offer was accepted. And you can see Alameda County has been outperforming the other two counties for quite a while, actually. Most of 2024, most of 2025. The only time where they weren't is where the increase is so steep. You're off by 1 week, and you can't tell if you're above or below. And then even 2022, basically, that's interesting. Basically, all the way back to the pandemic, the affordable areas, Alameda County came out and was on the top and remains on the top on the magnitude of overbidding. I don't think I noticed that previously. Moving on to frequency of overbidding. Here, they're essentially identical. I can't tell the difference because Alameda County is the least at over 60%, and Santa Clara County is the most, and it's probably at 61%. So there's less than a 1% fluctuation between all three counties. And for the most part, they've been pretty close together, with San Mateo County probably doing least well early after post-pandemic, but now they're all back together doing the same. Here's long-term appreciation. Santa Clara County is actually outperforming at about 95%, actually about 97% appreciation. San Mateo County is second, followed very closely by Alameda County. Both of those are about right around 73% appreciation. So 95 to 73. So Santa Clara County is doing 20% basis points better. Here's the long-term pricing. You can see that we're still below our peak pricing of 2022. And two of the areas, being Alameda County and San Mateo, are slightly below their 2021 peak pricing. Santa Clara County is significantly above their 2021 peak pricing. Santa Clara County seems to have done their appreciation relative to San Mateo County starting the latter half of 2022. Here's the same information on regular paper. The previous was on logarithmic paper. And here's going through the monthly payment. I assume an 80% loan using the national average for high balance conforming loan limits. Here's the raw data, whether you're looking at Silicon Valley overall, Santa Clara County, San Mateo, or Alameda County. You can see inventory. New listings are starting to come down. Inventory is starting to come down. Today's unsold inventory is relatively flat. It went up, which is a slowing marketplace in Santa Clara. Went down in both San Mateo and Alameda County, which is an improving marketplace. 3 different measures for marketing time. The median, which really doesn't change much that we talked about, right around 14 days. The average right around 26.5 days. And then the 75 percentile at 31 days. You got your different metrics. And I actually have 2 different appreciation levels, one since 2015 and one since 2020. And typically, whatever the appreciation is the highest, most recently is the highest overall. So the highest most recently is Santa Clara County at 38%. You come up here and it's the highest overall at 97%. Second place, here's an example where it doesn't work, because Alameda County is next at 125.9, basically 126, and its 2015 appreciation is 171, where the appreciation for San Mateo County is lower initially at 125.1, so 0.8% lower, but yet the appreciation since 2015 is actually 3 percentage points higher. So that's an exception to the general rule, but they're very close together. And I think that's why the exception happens. It's hard to overcome a 12-point differential with Santa Clara County. Now we're leaving the Silicon Valley and going on to the Greater Bay Area. And we're first looking at inventory. Inventory is going down in all 5 regions across the board, as you would expect. The seasonal influence is too strong to overcome. This is the number of offers that are accepted, coming down in Silicon Valley, flat in North Bay, flat in Central Valley, flat in the cities, and flat in Central Coast. So basically 4 regions are flat and decreasing number of offers in Silicon Valley. Silicon Valley is, in my perception, Silicon Valley seems to be the one that impacted the most by the holidays. Here's days unsold inventory coming down in all 5 regions. The least steep is Silicon Valley. Cities, all 4 of the other regions are coming down pretty quickly. Remember, a decreasing days unsold inventory is an improving marketplace, more favoring, the lower the number gets, the more aggressive the marketplace is, the faster the turnover rate. Here's marketing time. Marketing time is still climbing or flat in all 5 regions. So days unsold inventory is already coming down, but marketing time is still climbing. So you have a contradiction there, an apparent contradiction, but marketing time lags behind days unsold inventory slightly by a couple of weeks. And you can already see sort of Central Valley is flat, North Bay is flat, and cities might be rolling over right now. So in a couple of weeks, I would expect days on marketing time to start going down. Here's the frequency of price reductions, increasing number of price reductions in all 5 regions. Central Valley is probably flat, but 4 of the regions are clearly down. Central Valley is flat, so that's indicating a slowing marketplace. So there are a little bit of a hysteresis in the marketplaces. Remember, days unsold inventory is already improving, but yet you have increasing large price reductions. Here's the frequency of the price reductions, and it looks like they're flat in just the last week in Silicon Valley, also in the cities, rolled over a couple weeks ago in the Central Valley, but still climbing, although getting shallower in the Central Coast and the North Bay. So again, this would be an improving metric, or approaching an improving metric as far as decreasing number of sellers reducing their price. We're not yet reached the decreasing number of sellers, but we're going in that direction. This is the overbidding. So this is a lagging indicator, and this is magnitude. So the highest overbidding is in the cities at 10% overbid, followed by the Silicon Valley at 5.5% overbid. Then you have the North Bay right at the seller's ask price, and no, not above, not below. Then you have Central Valley at about 0.75% below the seller's ask price. And this area taking the largest price reductions is the Central Coast at about 1.75% below the seller's ask price. This is the frequency of overbidding. So the most common in the cities fall closely by Silicon Valley, both in the low 60s. Then you come all the way down to 37% for the North Bay, Central Valley at 30%, and Central Coast at 22% of the sellers are getting overbid. So anywhere from 22% up to 65% of the sellers are getting more than their asking price, depending on the region. Here's the long-term appreciation. The big takeaway is the cities that has done the least well at only 50% appreciation. Silicon Valley, Central Valley, and Central Coast are doing very well at somewhere between 84% and about 88% appreciation. And then North Bay is sitting down at 64% appreciation. Here's the monthly payments going through the 80% loan, directly related to their price order. Again, you can see the payments are basically at or above their 2021 price point, but they're consistently below their 2022 price pointing. Here's the estimated monthly payment. Again, the order is going to be the same as the median sold price. And here's the raw numbers. This presentation is a little bit different. Now is the current week, percent change from 1 week ago, percent change from 5 weeks ago. This is what we've already gone over. So that's the end of the presentation. Silicon Valley Real Estate Marketplace. Not seeing any unmuted mics, so thanks for joining. Take care. Bye for now.